Hello there again, Hector Davil here. In a previous video, I was showing you the forexfactory.com economical calendar. Alright, if you remember, we were browsing through all these different news announcements scheduled for the week, and we were also mentioning how Forex Factory kindly colors each different news announcement either in red, orange or yellow. All right. We also determined how those colored in red are the only ones that can have a significant impact on your forex charts, and therefore those are the ones that you should be focusing your attention on. Well, as we can see here, we have plenty of different news announcements colored in red. Okay, manufacturing PMI, gross domestic product, the ISM manufacturing, etc., etc. We have plenty of them, all right, that are released on a daily basis. And my goal with this video is to explain the most important ones, okay, the ones that the ones that can easily affect and spike your forex charts, and therefore the ones that you should grow familiar with at least to a minimum extent. Okay, so in this video I'm going to explain what all these different news announcements are, right? Again, the most important ones, those ones colored in red once again. Okay, and so like I say, next time you check your economical calendar and you recognize any of those different news announcements scheduled for that current trading session, well, you will know what the news announcement is about, how it may affect your forex chart, and therefore you'll be able to take better trading decisions. All right, okay, let's get going. All right, let's start with the biggest and the baddest kid on the block: the interest rates, and as an extension, the central bank announcements. The thing is that interest rates are the single most influential element on the forex markets. I mean, the forex markets move, price in the different currency pairs move the way they do, partially to a great extent due to interest rates. And that's because a universal economical principle: money seeks the highest yield. All right, I'll repeat that: money seeks the highest yield. And therefore, any change on the monetary policy, any change on the interest rates, any central bank can apply to their currency, to their respective currencies, well, it will obviously affect the forex charts. Okay, let's take the euro against the American dollar. For example, let's imagine the American Federal Reserve decides to bump the interest rates by a full 1% on the American dollar, and which, by the way, that's something that's never going to happen. Interest rates are cut or bumped by 0.25 or 0.50% at the most. I've never seen a full 1% interest rate bump, but at any rate, let's imagine, just to round it up, let's imagine again that the American Federal Reserve does push the interest rates up for 1%. Anyway, what do you reckon is going to happen worldwide? What do you reckon is going to happen to the demand of the American dollar? Well, obviously it's going to go through the roof, all right? The demand for American dollars worldwide, all right, all over the world, are going to go up, because now the American dollar is offering a higher yield, all right, on American dollar deposits, right? The interest rates have gone up, and therefore investors all over the world are going to look to exchange their local currencies into American dollars, again, to get, better returns on their investments. So, if globally the demand for the American dollar, right, again, worldwide, billions of dollars are going to go, or billions of units of any currency are going to be switched or exchanged into American dollar. Therefore, the demand for this particular currency is going to go up, and therefore, as a result, the chart for the euro against the American dollar is going to tank. Literally is going to tank. I've seen price spiking for over 250 pips for a standard 0.25 bump or cut. So if a full 1% was to actually happen, I would not be surprised if price would spike for 800 pips, 1000 pips within one single trading session. I would not be surprised. All right, that's how much interest rates can affect the forex markets. All right. So next time you look into your economical calendar and you see any news announcements related to interest rates or any announcement coming from a central bank, which at the end of the day, the central banks are the institutions deciding on interest rates policies. So at the end of the day, it's the same thing. So like I say, next time you check your economical calendar and you see this type of announcements being scheduled on that precise day, my advice is to stay away from that particular currency. For example, if we are having the interest rates coming out for the Japanese yen, all right, or the Central Bank of Japan is making an announcement, my advice is to not take any trade on any Japanese yen cross for the rest of the day. American dollar against the Japanese yen, euro against the Japanese yen, Canadian dollar against the Japanese yen, any currency pair involving the Japanese yen on that precise day is going to experience massive chaotic volatility, precisely because of that particular news announcement related to interest rates. All right. So again, my advice as a conservative trader is to stay away from any currency pair involving that particular currency where the news announcement, the interest rates announcements is coming out for. Okay. All right, next one up, unemployment data, or for all of you who are in the US, you may know this as the non-farm payrolls. Anyway, unemployment data is the second most important news item across the board, only second to the interest rates. And the reason for that, the reason as of why the forex markets pay such a close attention to the unemployment report is because it's probably the most reliable piece of information as far as determining the general health of an economy. I mean, historically wise, we've always seen unemployment ratios being rather low on those economies where things are ticking the way they should. In the other hand, on those economies where, well, the state of things, unfortunately, are not running as smoothly as they should. Well, one of the first symptoms, one of the first problems we usually see is unemployment ratios going up. Okay, like I say, unemployment and economical problems walk hand by hand, and that's why the markets obviously pay close attention to this particular report. By the way, the experts, the market analysts tend to agree that any economy sporting an unemployment ratio of 6% or lower is an economy that's at full employment, all right? And therefore it's an economy where things, the economical shape of the country is very well, all right? So if that's your country, if your country happens to have an unemployment ratio of under 6%, well, pat yourself in the back. That's something to be something to be proud about. Okay. Okay. The third most important news announcement is inflation, which, as you probably know, is the variation of price across time, from month to month, from quarter to quarter, from year to year. But at any rate, how much the price of one particular item changes or varies throughout the month, throughout the quarter, or throughout the year. All right? Now, the reason as of why inflation is so important to the forex markets is because inflation is one of the elements the central banks take into consideration as far as elaborating their interest rates policies. As we've already established, anything that's got to do with interest rates is massively important, and therefore, since the inflation influences the decision of the central banks as far as interest rates goes, well, therefore inflation in itself is important as well. All right. For all of you who studied macroeconomics in college, you should be familiar about the relationship between inflation and interest rates. I myself studied also, I majored in finance and economics, and boy, macroeconomics were a pain. It was a nightmare. But anyway, for all of you who may not be familiar with this, let me explain very briefly what this is all about. Okay, in a nutshell, and this is probably oversimplifying things, but the last thing I want to do here is to put you guys to sleep. So I'm just not gonna get overly technical here. Okay, now there is a direct relationship between inflation and interest rates. If inflation is going up, sooner or later interest rates are going to follow suit and they are also going to go up. On the other hand, if inflation goes down, or even if we go through a period of deflation, sooner or later we are going to see a cut on the interest rates. Now, please remember that inflation keeps track of the variation of price for basic goods, okay, basic items, food, housing, clothing, a cinema ticket, all right, a dinner at a restaurant, those kind of things, okay, those basic things. That's what inflation keeps track of. Well, if the price for those basic items go up, if inflation goes up, the spending from consumers, from citizens, from families is also going to go up. At the end of the day, again, those are basic items. Families need to spend their money on that kind of stuff, right? So if the price goes up, their familiar spending is also going to go up. On occasion, it's going to go up beyond their means, all right? Beyond their means. And that's why a central bank should be concerned about. I mean, at the end of the day, the job of a central bank is to control or to secure a stable money flow in the society, all right, within the economy. And therefore, if families are spending beyond their needs or beyond what they can afford, well, that's obviously to be something to be concerned about, isn't it? Well, how do they keep the families from spending way too much? Well, they need to encourage families or consumers to cut down on their consuming habits, all right? They have to encourage them to cut down on purchasing new stuff, on buying a new car or buying a new iPod or those kind of things. Basically, they need to cut down on the consuming ratios. So how do you do that? If you were a central bank, or if you were the head of a central bank for any particular country, how will you manage that your citizens, the people living in your country, cut down on their consuming habits? Well, there is just one way, I'm afraid. You need to reward savings, all right? You need to encourage them to, instead of buying a new car, they put those $20,000 into a savings deposits, all right, into a savings account. And how are you going to encourage them doing that? Well, very simple. There is just one way. Once again, you are going to have to offer them better yields, better rates for their money. All right. If you offer them better returns for their savings, next time they have $20,000 in cash, well, they may consider putting that money on a savings account instead of buying a new car. Right. And that's where the direct relationship comes in place. The central banks will have to increase the interest rates in order to stop or in order to cut down the consuming habits, and as a result, in order to control down the prices of those basic items. Hopefully, if more and more people begin savings and the demand for those cars, the demand for those iPods or for those cinema tickets begin to go down, well, so will eventually the price for those basic items. All right. So again, direct relationship. If inflation goes up, interest rates goes up. So, wow, that was a full mouthful, wasn't it? Anyway, let's imagine we have our standard euro against the American dollar chart. The inflation report comes from America, and we see that the inflation is going up. All right. How is that going to affect the chart for the euro against the American dollar? Well, if the inflation for the United States is going up, the euro against the American dollar as a whole is going to go down. The chart is going to go down. It's probably going to spike down. Why? Because the higher the interest rates, the higher the inflation, the higher the interest rates. And as we've seen already, if the rates for the American dollar go up, the euro against the American dollar is going to go down. Again, it's a direct relationship. All right? Now, inflation is usually released to the market in two different reports. In one hand, we have the consumers' price index, and in the other hand, we have the producers' price index. All right? The CPI keeps track of those basic items we, as individual consumers, purchase on a daily basis. Again, cinema tickets, food, clothing, that kind of stuff. Okay, this is the citizens' inflation. In the other hand, the PPI, the producer's price index, is the manufacturer's inflation. Here, we would keep track of the price variation of raw materials. Now, why do we care about the price variation of raw materials? Well, if those raw materials, basically the things that firms, companies, corporations need to acquire in order to produce, their retail products, well, if the price of those things go up, sooner or later, the companies will have to reflect, or transfer that increase in price to the final products, and therefore we, as individual consumers, will end up paying more for those products, and that's where inflation comes in place. Okay, so again, just for you to know that you will find two different type of news announcements on your economical calendar: consumer price index, producers price index. They are both related to inflation, and they both have a direct relation on interest rates. All right, and therefore they work more or less in the same way. Okay, let's now move on to the gross domestic product, or GDP. The GDP measures the value of all goods and all services produced within the borders of one particular country. For example, let's take the United States. Well, the GDP would be made up by the combination of the dollar value of absolutely every single good and absolutely every single service. All right, you just combined the dollar value of all that, all right, and you get the gross domestic product for the United States. As a general rule of the thumb, again, the market analysts tend to agree that a GDP growth of 2 to 2.5%, all right, per year is a solid growth for a healthy, stable Western economy. All right, whenever any of the Western economies is growing at a 2 or 2.5% per year, it means that things are running smoothly. All right, and therefore, well, the economy of that particular country is at good shape, and that usually happens when, again, unemployment is around 6% or lower. All right. Again, in theory, different countries, usually can vary those percentage a little bit up, maybe a little bit down, but at any rate, a healthy gross domestic product of 2.5% per year on a Western economy usually signals a very low unemployment rate. All right? Anyway, so how does the gross domestic product affect our forex charts, which at the end of the day is what we forex traders care about? Well, let's imagine we have our standard euro against the American dollar, all right, and we get the news announcements as far as the gross domestic product goes, and let's imagine it was for the American economy, and it was better than expected. The report shows that the American economy is growing. How is that going to affect our chart? Well, let's think about it for a second. The gross domestic product, a growing gross domestic product means that, well, corporate earnings in America are going to be probably strong for the upcoming year. It means that the stock markets are probably going to go up, that kind of stuff. Well, foreign investors, investors from all over the world, Japan, China, Europe, from all over the world, are going to be looking to convert their local currencies into American dollars in order to invest into into the American economy, into the American corporations, into the American stock markets, etc., etc. Therefore, the global demand for American dollars is going to go up, and therefore, the value, the relative value of the euro, if compared to the American dollar, is going to go down. All right? Because obviously the value of the American dollar is going up, and therefore, again, the relative value of the euro against the American dollar is going to go down, and therefore our forex chart is going to go down. On the other hand, if the gross domestic product was worse than expected, the euro against the American dollar chart would go up. All right, as simple as that. All right, next one up, retail sales. The retail sales is an index that measures the total sales of goods by all retail establishments within the country. Okay, any type of retail establishment you can think of. Well, if you combined their sales together, that's what you get on this report. Okay, so if the retail sales for any particular country, let's imagine the American dollar, well, if the retail sales goes up, it means that the consuming habits of American citizens are strengthening. Okay, they are spending more money on on retail products, and therefore that's a sign that the American economy is doing well. All right, or at least people have enough money to buy retail products, and therefore the value for the American dollar is going to go up, and as a result the euro against the American dollar is going to go down. All right. Okay, trade balance next. You are probably familiar with the trade balance. It measures the difference between exports and imports. Obviously, any country, any company, any individual wants to make more money out of the products he sells than what he spends on the products he buys. Therefore, if the trade balance is positive, it means that the exports are higher than the imports, and therefore that's positive for that particular currency. Okay? All right, the current account. The current account in its nature is very similar to the trade balance. In fact, the trade balance is part of the calculations for the current account. Let me be more precise. The current account for any particular country, let's imagine the United States, well, is the difference between exports and imports, which, as we've already seen, this is the trade balance, plus an extra element, which is the net money transfers. Basically, the difference between all the money transfers coming into United States and all the money transfers going out of United States. Those two elements combined together is the current account. And well, since the current account is in its nature very similar to the trade balance, it also is going to affect the forex chart in a similar manner. If the current account for any particular country is positive, that particular currency is going to appreciate its value, and therefore if we have a positive current account for United States, and therefore the American dollar appreciates its value, the euro against the American dollar, right? The euro-American dollar chart is going to go down. All right, the industrial production. This one measures the monthly change in the total output of industrial facilities, such as factories, mines, etc., etc. You know, it basically keeps track of the health of the industrial field on an economy. All right, and therefore, the stronger it is, the stronger the economy as a whole, and therefore, the stronger the currency. The durable goods report measures the total sales of durable goods, right? Now, what is a durable good? Well, it's an item with a normal life expectancy of 3 years or more. Many home appliances fall in this category. I'm thinking about, for example, a refrigerator, right, or a washing machine, or a TV set, you know, that kind of stuff. Obviously, if the durable goods report is positive, it means that people are buying more TV sets, more refrigerators, and as a result, the economy is expanding, all right? And therefore, that country's currency should be strengthening too. Alright, let's now talk about housing and construction, which is not a unique news announcement per se. In fact, it's a set of different individual reports, all of them obviously related to the housing and construction industry. Alright, I'm talking about the building approvals, building permits, housing starts, home loans, home sales, and existing home sales. Alright, they've become rather important ever since the last credit crunch crisis. Obviously, since the housing field, since the housing industry was one of the industries that got hit the hardest by the credit crunch crisis. Well, these reports are now followed rather closely as as an indication of how well the economy is recovering from that credit crunch crisis. All right, especially the housing starts, the home sales, and the existing home sales reports have become rather important as of lately. All right. Obviously, if these reports are better than expected, it means that the different economies are recovering from that housing crisis, and therefore the currencies, their respective currencies, should also be strengthening. All right, the Treasury International Capital, or the TIC data. The TIC data basically keeps track of cross-border portfolio investment flows between U.S. residents and foreign residents. All right. Basically, what it tracks is the flow of investment money, investment capitals, how much U.S. residents are investing abroad and how much foreign investors are investing within the United States. All right, I'm talking about investments as far as bonds, all right, public debt, etc., etc. If the TIC data is positive, all right, it means that more and more people will be converting their local currencies in order to invest into in U.S. assets, and therefore the value for the American dollar is gonna go up. Alright, now let's talk about the Purchasing Managers Index survey, or the PMI survey, which obviously it's a survey that's conducted on purchasing managers for different corporations, different companies across the country. Alright, basically the idea here is that businesses usually react quickly to market conditions, right? And their purchasing managers, the executives placing orders for new raw materials, well, those guys usually hold perhaps the most current and relevant insight into the company's view of the economy. If the company believes that the economy is expanding, and therefore if the company believes that there's going to be a strong demand for their products, the purchasing managers are going to increase their orders for new raw materials, right? Well, basically what they do is they simply conduct a survey upon these purchasing managers in order to gauge an idea of what the companies think, what the companies believe as of where the economy is headed. Now, they usually the organism conducting these surveys is the ISM, which is the Institute for Supply Management. Anyway, you don't have to learn that, all right? You don't have to learn any of that. But just to know, you should just know that there is a survey conducted every month on these guys, and it's rather important. All right, now, just as we saw on the housing field, these surveys are not unified into one single report. In fact, there are different reports, one for companies on the services field, another one for companies on the manufacturing field, and another one for non-manufacturing. All right? This index is based on the 50 level, all right, the 50 base level. Anything, any outcome above 50, it means that these companies believe that the economy is expanding, all right, and anything below 50, it means that the economy is contracting, or that these companies believe that the economy is contracting, and therefore they are ordering less and less raw materials, right? Like I say, anything above 50 is good for the economy and therefore good for the currency. Anything below 50, well, it's not so good, I'm afraid. Okay, well, we've finally reached the end of this video, the end of this long, boring, think and theoretical video. I am aware of that, I do apologize. But at any rate, I thought that it was interesting to show you guys the 12 most important news announcements of the Forex market. Now, anytime at the beginning of your trading shift, when you pull out your economical calendar, if you find any of these news announcements being scheduled for the day, well, you're gonna have to include that into your trading decision taking process, okay, at least for the rest of the day. Now, don't you worry, we are going to see all about that on upcoming videos. We are going to see how to trade them, how to benefit from them, how to blend these news announcements into our daily technical analysis routine, etc., etc. But like I say, I thought that before we get into that, you should know what is the definition of each of these different news announcements. All right, I mean, if you're gonna trade them, if you're gonna risk your account trading these news announcements, you may as well know what you're trading, right? So that was the point of this video. All right, folks, thanks for watching. I'll be waiting for you at the next video. Thanks.